Warren Buffett likes to only invest in businesses that he thinks he could own forever. There are many things he likes to look for in potential investments, yet one of the most important parts of his research is evaluating the company's management. They are the ones running the company, and therefore your returns, after all. With a great management team, you can sleep comfortably at night, knowing other talented people are doing all the hard work for your investment. Evaluating a company's management is no easy task, but Warren Buffett's method can be broken down into 5 simple things to look for in almost all companies. The first thing is to make sure you can trust the management team. Buffett looks closely and carefully at the management's history. If there is anything that any executive has done in the past that is fraudulent or illegal, he steers clear of the business at all costs. To assess a management's trustworthiness, first, do a simple background check on all top executives, especially the CEO. Usually, a simple Google search and some news articles will do. Once you know that the management does not have an obvious criminal history, it is up to the investor to decide whether or not the management can be trusted as head employees of the company. For this, read some annual reports of the company and check to see what the management has said in the past. If they talk about how they are going to conquer the world in past annual reports, and instead only conquer a small piece of the market, they likely are not trustworthy management. Also, if the management seems to be crazy about the positive results of a business, but never shares the negatives, this management can likely not be trusted. Every business has its ups and downs, so management should share the accomplishments and failures of the business. Never forget that the company's management team are expert salespeople and are always trying to get you to invest in the company. The key to finding a trustworthy management team is finding one that is honest and transparent above all else. The second thing is to make sure the management is competent. As the owner of a business, you want to know that your company's executive management has at least some pre-qualifications for being there. Generally, the more experience in an industry the company's management has, the better. If there is a CEO that has been at a company for decades, he will likely make better decisions than the CEO at another company who has just come out of business school. This is just generally speaking, of course. There are exceptions because some managers are truly exceptional regardless of their experience. Management should also know a lot about the industry they work in. It would be pretty strange to see an entire management team of a pharmaceutical company made up of ex-automaker management. At the very least, make sure the management has a good idea of what is going on in the company by reading their statements to shareholders. You can also research to see what competitors or industry experts think of your company's management, and make your own judgment based on that. The third thing to look for is a management that avoids taking excessive risks. A management team can be honest, trustworthy, and experts in their industry, but if the management does not avoid taking serious risk, nothing else matters. Management must make sure to keep debt at a reasonable level to make sure the business will not have to worry about bankruptcy. The debt-to-equity ratio can be used to evaluate how much risk the management is taking on. The debt-to-equity ratio is equal to the business's total debt divided by the amount the shareholders actually own in the business. or more formally, it is known as total liabilities divided by shareholders' equity. If the total debt of a company is $5 million and the shareholders' equity is $10 million, the debt-to-equity ratio is 0.5. If the total debt of a company is $50 million and the shareholders' equity is $10 million, the debt-to-equity ratio is 5. It is usually better to see a lower debt-to-equity ratio of around 0.25 to 1, since this means that the company is at the least risk of going bankrupt. Management is avoiding risks if they can keep their average debt-to-equity ratio at a low number over the years. If you compute a debt-to-equity ratio of, say, 2 or more, do extra research to make sure that the management is confident they will be able to pay their debt on time. But just know, these situations are generally riskier. Notice how it is a debt-to-equity ratio of 0.25 instead of 0. Most companies that have absolutely zero debt are often not effectively managing money to deliver the best possible returns to their shareholders. Almost all successful businesses have some debt, after all. The fourth thing to look for is a management team with skill. As a shareholder, the management team are employees of your company, and they should be very successful at their job. An excellent management has to invest the business's money effectively and reward shareholders who have a long-term time horizon as owners of the business. A useful ratio to measure management skill is called the return on invested capital, or ROIC. ROIC can be calculated in a few different ways, but Warren Buffett likes to calculate it as the cash the business produces for owners divided by the long-term debt plus shareholders' equity. Cash flow for owners is calculated from the cash flow statement and is basically operating cash flow subtracted by the capital expenditures needed to run the business. If a business produces $100,000 of cash flow for owners a year, and they have $200,000 of long-term debt and $800,000 in shareholders' equity, the ROIC would be 10%. ROIC measures how well management invests money for the owners of a business. If a company is not paying all their cash they produce as dividends, this number tells you how well management is doing without giving the money to you. Warren Buffett looks for businesses with a consistent 10% ROIC or more for many years. Basically, you want this number to be as large as possible. If the company has a high ROIC, it is best to let a company invest your cash flow for owners instead of paying a dividend. This way, as a shareholder, you don't have to pay taxes on the dividends and can let your business's cash flow grow internally. Stocks with a high ROIC for many years likely show that the management is very skillful as investors and work hard for the long-term shareholders like Buffett. The goal of finding great investments, according to Warren Buffett, is to look for businesses with low debt and high returns on the cash produced from the business. The final thing is to make sure management has skin in the game. What good is a management if their goals are not aligned with the shareholders of a company? If management is only paid a salary and nothing more, what would motivate them to improve the business and increase returns to shareholders through dividends or rising stock prices? The management team have to be owners of the business too. It is best when a significant portion of their compensation is in stock awards. For example, in 2019, Intel CEO Robert Swan was given a base salary of $1.3 million. He was also awarded a staggering $61 million in stock awards. Do you think that his values are aligned with shareholders? Of course they are. The best type of skin in the game management can have is if they are the founders of the company. Many founders of a company would rather lose absolutely everything in life before their own business dies. This puts their goals directly in line with the shareholders of the business. For example, Elon Musk has about 75% of his net worth in Tesla stock. I think this says enough about whether or not he has skin in the game. The key takeaway is to always look for businesses where the management's goals are aligned with yours as a shareholder. If the people running the company don't care about the quality of the business, who will? Warren Buffett likes to see management as one of the most important components of a successful investment. If the management of a company have these 5 traits, the investor can sleep easy at night knowing the best people are running their company for them. Even an outstanding business can become a terrible one with bad management. Think of AT&T, a wonderful company in the past that made a series of bad acquisitions and decisions that cost shareholders a lot of money. Of course, Warren Buffett's own words say it best. When we own portions of outstanding businesses with outstanding managements, our favorite holding period is forever. Thank you so much for watching. Please leave a like and subscribe if you'd like more content like this, and I'll see you again next time.